Let's talk about using options to buy stocks at a discount. Owning shares is a dream most people have shared at some time or other. But many people also fear the perceived risk in doing so, and for this reason hesitate. But did you know that if you understand something about options and you're thinking of owning shares, you could be using options to buy stocks at a much cheaper price than if you just went to your broker and simply bought them at market prices? Let's take an example to illustrate how it works. Let's assume the shares of a company are currently trading on your local stock exchange at $35, and you believe they would be a value investment if the price falls another $5 or so. You may have concluded this for any number of reasons. For example, you may have looked at a daily price chart of the stock and noticed a longer-term trading pattern such as a channel. A channel is when highs and lows exist between two parallel lines. Or you may have observed a strong price support area. This leads you to believe that it won't be long before the price will fall to, say, $30 in the near future, at which price the shares are worth buying. You understand the advantages of using options to buy stocks. Another reason could be that you're an investor who looks at the fundamentals of the company. You've noticed that the price-earnings ratio is lower and have concluded that $30 is a good price to buy. Or you might be a short-term stock trader, and you've observed this company's stock price starting to fall in such a way that is consistent with past movements of a similar size. So you believe it is likely to reach $30 sometime within the next month or so, and you're happy to buy it at that price because you are confident that it will turn around and head north again. Or you might just be a long-term investor who prefers to buy stocks to hold for the long term for dividends and capital gains, and would like to get a better deal on the purchase price. Here's how to do it. So, shares in a company are trading at $35 today, and you're prepared to buy them if and when the price reaches $30. You would need sufficient funds in your broker account to purchase the stock at the $30 price tag in order to utilize this strategy. So when the stock is trading at $35 or less, you would sell out-of-the-money put options with an expiration date the following month and an exercise price of $30. Selling options contracts is sometimes called writing, and the process involves creating them out of nothing. Selling an option contract with a $30 exercise price means that you are obligated to allow the market to put shares to you for $30 per share up until the agreed option expiration date. In consideration for giving this right to others, you would receive a premium, which would be credited to your account. The premium is yours to keep, no matter what happens after that. Let's say you receive $2.50 for each share covered by the contract, and you sold 10 put option contracts. Assuming that each option contract covers 100 shares, you would receive $2,500. That is 10 times 100 times $2.50. After you've done this, one of two things can happen. Here's the first scenario. The share price could fall to $30 or less by the option expiration date. In this case, the options would probably be exercised and you would be forced to buy the shares at $30. 1,000 shares would cost you $30,000, minus the $2,500 you received for selling the put options. Now, $30,000 minus $2,500 equals $27,500. And this means that the effective cost to purchase those 1,000 shares is now only $27.50 per share. But let's have a look at another scenario. The share price doesn't fall to $30 or lower. In this case, you simply keep the $2,500 that you received from selling the put options and walk away with a profit. Okay then, so let's say that the market price of this company's shares had fallen to $28 by the time your put option contract expired. You would still be obliged to purchase 1,000 shares at $30, but the whole deal would still only cost you $27.50 per share. If you had not used this put option strategy and had waited instead to buy when the price fell to $28, you would have paid $28,000 and be out of pocket an extra $500. So you're still ahead. But we haven't finished yet. Here's what you can do next. Now that you have purchased 1,000 shares at $30, the next thing you may wish to consider is to immediately sell, that is to say write, out of the money call options on those shares that you've just bought. The preferable strike price in our example would be at least $30, but higher is better. That way, if the share price rises, you make some gain on the shares if the call options are exercised. But if this company's stock price keeps falling, the call options might expire worthless, and you simply keep the extra income, thus further reducing the overall cost of your purchased shares and offsetting any capital loss. Now, let's add an averaging strategy. If the share price continues to fall, and if you still have more funds available, you could use an averaging strategy to buy more of this company's shares, but this time for, say, $24. Let's say the price has fallen to $28, as already mentioned, and you have purchased your 1,000 shares at $30, but remembering that, thanks to your option strategy, your effective cost was only $27.50. So you now immediately sell more put option contracts with next month's expiration date, but this time with an exercise price of only $24, receiving a further premium of, say, $2.50. If the share price doesn't fall as low as $24 by the new expiration date, you keep the premium, and it further offsets the cost of your original 1,000 shares, which, instead of $27.50 per share, now effectively cost only $24.50 per share. Remember, if you had bought the shares at market prices without using put options, at this point your cost would be $30 per share. But let's imagine that some negative news for this company now appears, and its stock price fell as low as $20 by the new option expiration date. Your sold put options would oblige you to buy the shares at $24, less your $2.50 premium received for selling the options, a total cost of $21.50 per share. So you now own 1,000 shares costing $27.50 and a further 1,000 shares costing $21.50. That's 2,000 shares at a total cost of $49,000 or $24.50 per share. If you had purchased these shares without using options to buy stocks, just averaging down instead, they would have cost you $54,000 all up, or an average $27 per share. With the market price now travelling around $20 per share, without using options, your unrealised capital loss at this point would be $7 per share, or $14,000 for 2,000 shares. But let's always remember, you never realise a loss until you sell the shares. Your strategy may be to hold them until the price rises again and receive dividends in the meantime. Bear in mind, this is a worst-case scenario. A company whose stock price has fallen from $35 to $20 in 2 months is either in trouble or there's big economic news about. So even when the market is taking a dive, as described above, where the stock price has fallen over 2 months from $35 to only $20, if you had sold put options as part of your stock buying strategy, you would be better off by 2,000 shares times $2.50, that is $5,000. This is a 10% discount after brokerage costs. Now that the price has fallen to $20, you could sell more put options expiring next month and receive another premium, which will offset the overall cost of your 2 previous purchases. Or, since your average share cost is only $24.50, you might be happy to hold your 2,000 shares until their price rises again. By using options to buy stocks, you will eventually own shares in your chosen company at a discounted price, which in the long run will mean greater capital gains. Using options to buy stocks, as outlined here, is one of the strategies taught in greater depth in Module 11 of the popular Options Trading Pro System series of videos.